to talk about fund to fund this call?
I could talk about whatever you and Mike allow me to talk about. You want to talk about fund to funds? Who wants to talk about fund to funds? Oh, wow. Who doesn't know what a fund to fund is? What a fund to funds is that, let's say I've got Mike over here, and he's got a property, whatever his property is, right? Let's say he's got a property in Arizona here. Then over here is Mauricio, and I'm a syndicator, and I've got a property in California. I don't know why, but, and then I've got Jeff, who's making this up, over here, and he's got a property in Texas, right? So 3 separate operators are doing their own syndication. Well, what was your name, sir? Tim. So Tim could come along and say, well, this is great. I'm really good at raising money, but I don't want to do operations, or I don't know anything about operations, or maybe whatever the reason is. But he could raise money into a fund that he puts together. So maybe he raises $5 million into his fund from passive investors for the sole purpose of his fund investing in other people's syndication. So maybe he writes Mike $1 million check over here, and he owns, I don't know, maybe he becomes a 5% owner, an LP owner in Mike's fund. Maybe he puts $500K in my deal, right, and owns 1% of my deal, and whatever. But he's basically raising capital into his fund that he is then going to go out and do all the heavy lifting, right? He's going to go meet with the sponsors, do the due diligence, fly down, check out the property, walk through the property, do all this stuff, and then he's going to make a decision like, yes, I'm going to allocate some of my money that I, told my investors, because what he's going to tell his investors is like, you give me cash, and I'm going to go find, insert here, right? Multifamily deals in the United States, or I'm going to do, some people do mobile home parks. Or maybe it's a mix because there's some diversity. So maybe it's like, hey, let's get some diversity. And so I'll put some of the money in multifamily, some of the money in mobile home parks, some of the money in self-storage. But that's the idea of a fund to fund. And the challenge that we have these days is that, number one, it's very popular. But the biggest challenge we typically have, and I don't get too much in the weeds, but what we want to make sure is that Tim doesn't look like he's just raising money for Mike. Because in order to do that, he needs a license. He needs a broker-dealer license, right? And so he can't go raise money for somebody else without a license, just like you can't practice law without a license, or you can't practice medicine without a license. You can't go capital raise. The capital raiser show is in the house. The capital raise. You can't capital raise for somebody else without a license. And so one of the challenges we're seeing these days is the way people are trying to get around it, which is a legitimate way, is to do a fund of funds, because that way you're getting paid not to raise money for Mike, you're getting paid for a variety of different things. Number one, doing the due diligence and finding a good operator. Again, we're busy professionals. I'm a W-2. I don't have time to go fly down to Arizona. I don't have time to get on a plane and go do, and I don't know anything about it anyway. So having somebody like Tim do the due diligence on the sponsor, everything we kind of just talked about, do the due diligence on the property, go down and look at their operations, look at their team. Maybe what typically happens is, look, I'll ask Mike, I'll put him on the spot, but Mike, if I come to you and say, I've got $1 million for your next deal, I'm probably going to be able to negotiate some favorable terms, right? Maybe not, but generally speaking, I might be like, hey, I know you're paying everybody else 10%, but I want 12 because I'm giving you $1 million. You don't have to deal with 10 people. I'm going to deal with my investors, so it's easier for you. You just got to talk to me, one check, one K1, one thing. And so you can negotiate better deals. And that's part of one of the things that, Tim, you'd be getting paid for is, hey, if you go directly to Mike, you're going to get this return, but I've negotiated a better deal, or maybe we've got more of a seat at the table. We've got some say in the deal. Maybe Mike's is such an amazing deal, but his minimum's $250. And you don't have $250. Tim, his minimum's $50K. So now you have access to other deals that you ordinarily wouldn't have because it's Tim's in there creating value for you. And the second challenge is, because you're a passive investor, your fund is a passive investor, that makes you an investment advisor. Just the rules, right? So now Tim is he's advising his fund as to the sale of securities. Because even though Mike's buying real estate, Mauricio's buying real estate, Jeff's buying real estate, Tim's buying shares in companies. Tim's buying securities. So now I got to worry about investment advisory rules, and that's state by state. So Tim, you live in Arizona. I don't know off the top of my head what the rules are in Arizona, but you're gonna have to find an exemption. Otherwise, you may have to register as an investment advisor, which isn't the end of the world, but it's an exam and an application and compliance and blah, blah, blah. Now, when you are advising somebody else as to the purchase of security, the SEC looks at you, I put Tim here, but really this is your fund, right? So this is a fund, it's an LLC, and Tim over here is the manager and the sponsor. What the SEC looks at is like Tim is actually advising the fund as to the purchase of securities, which makes you an investment advisor. And unless you've got $100 million or more, it's going to be a state-by-state issue. So it's not a question of, it's a different issue than, it's one of the 5 things or 4 things. So broker-dealer is one of them. Separate from that is this issue of investment advisory. And so I think every single state has some exemption that you, but the problem is, and I don't remember what the ones in Arizona are, but for example, in Texas, which I know pretty well because I have a lot of clients in Texas, there's limitations. Like, okay, well, you don't have to register as an investment advisor. You can do the exemption. However, you can only accept accredited investors. Other states don't care. Pennsylvania couldn't care less. As long as you don't do 15 of these funds, you're good. So each state, it's just a state by state. My only point is it's another layer of compliance. Like you just said, it's another layer of compliance. I got to worry about broker-dealer laws. I got to worry about investment advisory things. I also have the problem is that this is a passive company that once it makes an investment, you're basically a passive investor. We got to make sure that we're not considered an investment company. Because if you're an investment company, it's another, web of regulatory things. So we want to not be an investment company. The easiest way not to be an investment company if you're doing a fund of funds is just to make sure you have less than 199 investors or less. So as long as you have 99 investors or less, that's fine. But I do have clients that are raising, if you're going to raise $100 million, you may have more than 100, and so that creates a problem as well. So there's just, the point here is not to get too much in the weeds, is just that it opens up, when you're doing a fund of funds, you open up a huge regulatory thing.